Good morning, everybody. I hope you can hear me. If not, please put something in the chat and we'll work it out in the background. Just while we have a few more people joining, my name is Nicholas Cully. I'm the Chief Commercial Officer of the Sovereign Group, and I'm going to be emceeing these series of three webinars, today being the first one. The subject for today's webinars, all of these are private client focused, but today we're going to be talking about international mobility, private client and corporate services. So I'll go into a little bit more information in a second as to the detail, a little bit more about what we're going to speak about. But first and foremost, let me just introduce you to the speakers. So on my left, at least, we've got Simon Denton, who is Managing Director of our London office and has been with Sovereign Group for 30-something years and is an expert on anything to do with UK tax. And so he's going to be talking a bit later. We have Lawrence Lancaster, who's based in Singapore, who's our group legal counsel, and also one of, we would argue, the leading experts on anything to do with domicile residency, UK taxation. So you're going to be hearing from him as well. And finally, Kerry Pratley, who's going to be starting off today, is our group head of residency and citizenship services. So before I go into a little introduction about today's subject matter, I just wanted a few house rules. We do have a Q&A and a chat function, obviously, on this call. If you have any questions, please could you put them into the chat? I will be reading the chat as we go through. If the question, obviously you're all muted because of the number of people on the call. So if the question is relevant to the topic that's being spoken about at that point, I will interrupt or find a juncture and a pause in the conversation and I'll ask the question. If not, there'll be 15 minutes at the end where we will have a Q&A session, but we want to keep the flow going. So we will try and ask questions as and when they arise. We are going to be starting off, as I said, to talk about residency planning and implementation, which Kerry's going to take us through very shortly. And then we're going to talk a little bit more about the pre-immigration and departure planning that needs to be done with a few real case studies and practical illustrations to sort of close up, which will hopefully shed some more light on how best to look into this for you and your clients. So just to begin with a short introduction before I introduce Kerry to speak, international mobility is no longer a niche question. You'll see here a little pie chart wheel up on the screen, which I'll just come to in a second. International mobility is a strategic reality shaping how individuals, families, and businesses operate across borders. As talent, capital, and opportunities move more freely than ever, the legal, tax, and regulatory implications of cross-border activity have become increasingly complex and closely interconnected. So this webinar is going to bring together insights from private clients and corporate advisory perspectives to explore how international mobility impacts both personal and business decision-making. We will examine the challenges and opportunities faced by globally mobile individuals and entrepreneurs, from residency and tax exposure to structuring, compliance, and long-term planning. So obviously, we've got a series of three webinars. Today, we're going to be talking about residency, tax residency, and citizenship, which is up there on the top right. We're going to go into some tax planning, and we're going to be speaking about trust and foundations and how they can assist with said tax planning and for those looking to perhaps move back to the UK or take up residency somewhere else. So without further ado, I'm going to pass over to Kerry Pratley to take us through some of the residency and citizenship schemes that we work with. Kerry.
Thanks, Nick, and thank you, everybody. I think the important point to start off with is to highlight, the group's extensive international mobility, private client and corporate services, supported by our global network of offices, specialist teams and experienced local partners. I mean, this is what sets us apart within the industry. And it allows Sovereign to collaborate with clients and their advisors on planning and executing cross-border strategies. And as a result, clients can gain access to various lifestyle advantages, enhanced flexibility, improved security, business opportunity, and tax efficiencies. Also, this is a, planned correctly, they provide a robust platform for structuring, managing, preserving, and distributing wealth, both for now and for future generations. We do tend to have, broadly speaking, our client demographic when we're looking at international mobility, can be divided into two categories. Firstly, those individuals seeking to maintain their current residency status, stay where they are, but possibly planning for the future, whilst also diversifying and gaining access to alternative countries and markets. Countries and markets that offer increased opportunities and advantages for themselves, their families, and their businesses. The second category relates to those individuals seeking to move or gain international mobility now, by finding a new country or even countries that offer substantial personal, business, and lifestyle opportunities. So to begin, and as is highlighted on the screen, we don't, the market often talks about the first set of programs, which are residency by investment programs, often referred to as golden visas. Now, they do have a place in this planning, of course. They provide residency rights, for a wide range of investment options, and they tend to have low minimum stay requirements in country. And so they are ideal for those seeking an alternative or second option. People may take up these options up in one or more countries while staying where they are today. Secondly, we look at financially independent. In addition to these, because a lot of our clients are moving cross borders and so forth, we'll also consider financially independent or self-sufficiency programs, which are ideal for applicants who can demonstrate they have an income or have sufficient income or sufficient level of assets that ensure that they're able to look after themselves. I mean, these sort of programs, they generally require that the individual moves to the country and become a tax resident, but they're a very useful tool for those who are looking, possibly first to move to a country and to get to know it before committing large sums of money, through investment in property or investment funds and these sort of things. Thirdly, and importantly, are business establishment visas, which provide residency permits to applicants who establish a new business or invest in an existing business. The reason these are important, obviously, it provides access to markets and so forth, but for the host country, it creates local economic activity and employment opportunities, within the country. So they're attractive to governments as well. And then, obviously, when dealing with cross-border solutions, it's important to consider the tax implications, and we will also consider which countries, we might be looking at low tax countries or those countries that provide special tax benefits to non-domiciled individuals who are moving to the country. Now, it's worth saying that not all countries offer special tax rates. We offer programs in Australia, the US, Canada, and also many EU countries, don't offer special tax rates. And in such instances, and Lawrence and Simon will discuss this later, it is important to consider local tax laws, and if it's all possible, plan how best to efficiently structure assets before becoming a resident of the country. So those are the for residency programs or considerations. We also look at citizenship. For those who have been resident in a country for a while, there are options to obtain a second citizenship or citizenship within that country through naturalization. As I mentioned, it requires that the individual is first established a legal residency. It may also require that they're a tax resident and that they are proficient in the local language. And then last but not least, obviously, citizenship by investment, which allows individuals to obtain an alternative citizenship relatively quickly through significant financial contributions, whether that through business or donation or into property or government bonds. Yeah, that's a summary of that. One other area I would say, it's important that clients plan ahead of time. And as I say, Simon and Lawrence are coming on to this, but it's certainly true that there is no one solution that fits all. So these decisions can be complex, but when planned and implemented correctly, they do provide significant benefits. And as such, strategies should be tailored to the needs of the applicant, their family, their business, because they require expertise in immigration, tax, legal, and or corporate services across multiple jurisdictions. So clients and advisors do therefore benefit from developing such comprehensive plans with internationally focused providers such as the Sovereign Group. Sorry, Miguel, could you just move on to the next slide, please? Thanks. The purpose of today is to not go into too much detail. So I've included these two slides to provide an overview of the countries and types of residency, tax residency, and citizenship programs, that we assist our clients with. So the first one here highlights the programs available in Europe and the Middle East and Africa. As you can say, it's split into the categories I previously mentioned. Could you please move on to the next slide? And obviously the second here provides the same information, but for Australasia, the Americas, the Caribbean, and Asia. So what you can see is that we do have a broad offering, and within each of those countries, there are, again, even more potential options that we need to consider when making plans for those planning alternative or second residencies. Yeah, please note, as I say, I'm not going to go into these individually, but a copy of the slides will be sent out after the presentation. And obviously anybody can please contact me direct if you'd like more details on specific country programs, at any time in the future.
Kerry, just given the broad number of products that we have and the international reach that you've just shown in this slide and the previous one, and given the broad demographic of clients that we represent, can you just let us know what type of clients are these types of services relevant to, and how do we differentiate from client to client? Like, which client would be relevant for, say, a USA scheme versus somebody who might be more appropriate towards Dominica, as an example?
Well, yes. I mean, obviously it's a wide world. We do have offices across multiple markets, and the clients in each market are very different. I mean, I think Simon may be looking more closely at UK nationals leaving, but you've mentioned the USA, for example. Whilst there are problems currently, or there's a lot of news about immigration in the US, for example, there are a lot of people across even Africa, the Middle East and Asia, even Europe, who still want their children to be educated in the US, for example. So there are, programs that are suitable for those. Also, people still want to emigrate to Australia or the US to move their family. They're not necessarily they're looking for the benefits that are available in those countries. So again, we have two broad types of clients: those who are staying where they are today, but are looking for the additional benefits to be gained from establishing alternative residency, or secondly, those who are actually planning on moving country.
Thank you.
And Nick, you're on mute.
Next slide. Good morning. Good morning, everyone. Nice to see so many in the room. So I'm Simon Denton, for the persons that might be arriving a couple of minutes late. The applicability of this slide, ladies and gentlemen, is a bit of a checklist, a bit of a guidance for persons leaving their current country gives them a guide to shortlist favoured nations that they might be contemplating. It may be for a business and entrepreneurial move. It may be a family combined move of younger and older children, pre-retirement, actual retirement, or even post-retirement to some extent. So this is the sort of pre-migration checklist that everyone should perhaps not take for granted. It's fairly obvious, but it's surprising that one or two of the points that I canter through this slide do actually take for granted when perhaps one shouldn't. And which countries might the family or head of family might want to move to? And for example, don't just make it tax driven. There's many favoured jurisdictions, domiciles that offer greater tax relief and exemptions, perhaps compared to the onshore world, but just don't always make it tax driven, ladies and gentlemen. Visa and visa eligibility, again, sovereign will assist with all of the jurisdictions that Kerry has mentioned and many more. But check out the visa. It's not a holiday. Check out the visa eligibility, legal rights and obligations. Tax system. Many of the countries that we have specified, with exception to a few, offer preferential tax regimes. They can be for a certain period of time. Spain is 6, Italy 15, Greece 15, and the non-dom regimes, even of Ireland, even more. So check out the favourable tax regime with sovereign as long and calculate how long that's going to be there for. Real cost of living. It's not a holiday, ladies and gentlemen. Real cost of living throughout the year, not just on the sunny times. Evaluate that very carefully. And if the family are moving for a variety of reasons, the young ones are probably might want to grow up in that country. Job market, career options, the legal, the fiscal, and those permutations do really have to be looked at in the new country. Many are the amount of people, 16,500, and that means over 17,000 in reality, left the UK. And with respect to people my age, a lot are a lot younger, and they moved for business, entrepreneurial, and a lifestyle change in that order. So check the job market, career options, the flexibility, the welcome ones received. With younger members of family, education system, that's the government public education system, which is of good quality in many jurisdictions. Those that are a little more affluent, or those that find that the private education system is a little less than, for example, the UK and continental Europe, especially Malaysia, the private system can be even better, preferred international education, and not so expensive than the mainstream jurisdictions. A lot of these jurisdictions require on entry the family or the applicant to actually have private medical insurance relevant to the country and the region. Talk about the EU. So best you get private healthcare or sustain private healthcare with the applicability to one's new country. But check out the emergency healthcare in the country relevant to all ages and as and when things unfortunately happen.
Simon, we've had a question through. Just presumably it depends on the jurisdiction that they're looking to move to, but how long does one recommend to spend, to before you're planning to move? How much time do you need to do all of this pre-migration planning?
With thanks, Nick. With a little bit of help from us, because we have 600 management and staff that are globally minded. Plus, we've helped thousands of clients move around the world for business, work, pre-retirement and actual retirement. I would say a good 6 months, and that's really to assess the climate, culture, lifestyle, safety, local legal system, the 2 points that I'm featuring. Family, probably a bit more with educational system. There's probably a short list of 2 countries. So I would say minimum 6 months. Often by the time you've gone there a few times and you've gone there with recommendations and sought some local advice, it can be the best part of a year or a tax year. you're preparing during the tax year to depart just before the end of the tax year. So don't want to make this UK specific, but the UK tax year runs from April to April. Many others run from January to December. So you're using most of your tax year to prepare for a departure. And you may find that the current tax year is not relevant because there's things to sell, dividends to take, children of a certain age have got to finish their current education arrangements in a secondary or primary school. So it's the best part of a tax year, Nick.
I'd agree, and especially in those cases where you're moving from a tax-friendly, tax-benign centre such as Singapore, Dubai, Hong Kong, and you're moving onshore to, say, the UK, but it could be France, wherever really. You want to give yourself that year, because often you're going to have to do, and we're going to come on to this in a minute, quite sophisticated planning. And you'll find that your time will run out. And as you mentioned, that valid point, Simon, with that UK tax, if you are moving to the UK, then it has that awkward 6th of April start to the tax year, which often catch people out. Kerry, I don't know if you've got a view on this as to how long you need.
I mean, 6 months to 12 months minimum, I would say. But also in addition to that, as I mentioned, some clients are planning ahead. Programs do change, policies change within governments, programs programs meet the requirements, the stated objectives, and change. So if there's something out there now, and for example, we have many clients in the Middle East and Far East who are are working there but may look to be retiring to Europe, or not going home, or Asia or Africa, Mauritius, these sort of locations, then it's worth planning ahead, because property price, even if it's 5-6 years down the line, because we know what the current tax status is, property prices increase, you can have access, you can still have the benefits that come with these residency plans and visit regularly. So in many cases, people will plan ahead.
And they often
many
talk about
years.
it. They often talk about it for a few years, don't they, Kerry, about buying the home in the sun, or the home elsewhere, and then that turns into, well, could we actually live here? And then the reality becomes, the dream becomes the reality. So a good year is the right answer. We better go to the next slide.
But also, unfortunately, the reality is that it could be determined by your passport as well, because some passport holders are going to take much longer than others. But anyway, next slide, Simon.
No, it's a good point. But a good year, Nick, is the
general
answer.
rule of thumb.
And a lot of talk about where we're going to go next. Anyway, did we get to the next slide, Miguel? That's it. Thank you. This is the sort of pre-departure practical checklist, ladies and gentlemen. And I'll just point out that apart from the deck being delivered to you by email after this presentation this week, you can contact any of us for further information. Our details are at the end. Nick will walk you through that. But Sovereign facilitates, our global group facilitates project managers, and often deals with all the in-country new arrivals in terms of business, entrepreneurial, migration, pre-departure and arrival planning. So finalising legal documents, immigration documents, it may seem fairly obvious, but once a decision is made, let's get it right first time, ladies and gentlemen. Make sure you move through the phases with the planning, with the tax advice, with a realistic departure date. If it's not this year, it can be next tax year. No one need totally undertake a rush job to do this. It's quite a life-changing experience. Frequency of travel. Many cases there's lots of flights going into a country in the peak months, but not a lot outside of those months, and connection flights. So assess the flights, the flight paths, the arrival, the departures, and if it's frequency, you need to not be an exile in one's country. You need to get back to your home country for family obligations and that sort of thing, making sure you try and not be resident of 2 or more countries, certainly for tax planning purposes. Often our clients rent first, if that's permissible. So find a place to rent 6 months. It's not a lifetime, is it? And then you may decide to move a little bit less in a less touristical place. And once you're there, once you're in a country, it's easy to look at the deals to buy a distressed property or a property that perhaps needs a bit of doing up. And I don't want to be compared to the Homes in the Sun program, but rent first is the norm and buy later. A requirement of a lot of countries promoting residency, and there's more than 30 these days throughout the world. Europe taking the lead, then it's the younger ones younger generation tends to focus on the Middle East, Dubai, Bahrain, and Saudi. Plenty of experience in that, but a lot require the programs require that one has the relevant private health and medical and travel insurance. So just make sure it's qualifying for the first year or two, but assess the public healthcare as well. Local language challenges, for European cultures, I recommend you try and learn it. You gain a great deal of respect if you do make the effort. Bit different in Dubai. I think there's 5 million population and 4 million are expatriates. So and everyone speaks English there. For business purposes, look at labour law, employment rights, employment law, obligations. Take nothing for granted just because you're used to one system in your own country. It may be a little more onerous, a little slower, sometimes a little more bureaucratic. There may be nomad visas. There may be just working visas go with immigration and residency visas, like in Dubai. And Kerry is an expert on all of this, and Sovereign can guide you through the process, the time frame, the costs, and leaving nothing to chance. That's your pre-migration and pre-departure practical checklist, ladies and gentlemen. To Lawrence, if there's no questions.
Yep. Okay. Thanks, Simon. Thanks, Kerry. So just a couple of slides now on principles of international tax planning in the context of pre-arrival. So the focus of this this checklist that I'm going to run through is for those individuals who find themselves currently residing in a no tax centre such as Dubai, or in a low tax centre or tax benign centre such as Hong Kong and Singapore. So it's very easy if you reside in these centres to crystallise profit, be it income or gains, now without incurring a tax charge in your country of residence. These clients are planning on moving onshore to jurisdictions where it's going to be a lot more difficult to crystallize that profit without incurring a tax charge. So most of these planning techniques are focused on what we call capitalizing income and capitalizing gains whilst you're resident in these tax benign centers before you move to a tax heavy jurisdiction. It's worth distinguishing these type of cases where you're moving from low tax to high tax to where you're moving from high tax to low tax or no tax. Because if it's the latter type of case, it's unlikely you're going to be wanting to do any of this, because why would you want to be crystallizing profit when it's going to be taxed, when you could reside in a place where it's not going to be taxed? It's important to distinguish those two types of case. I'm going to come on to in a minute to explain a bit more about these different jurisdictions in terms of when you move onshore, the different tax systems to which you will be subject. The focus with this checklist then is when you're still based in a tax benign centre, what do you need to do? I've made 6 points here in relation to pre-arrival tax planning. The first 2 are concerned with what I've said is capitalization of income and gains. This sounds really complicated, but it's actually very simple if you are based in these tax benign centres, which we're assuming the individuals are. So, for example, if you've got, say, if a private company and that company has in it some undistributed profit, you can take that out as the sole shareholder or one of the main shareholders as a dividend without that incurring a tax charge in your country of residence in one of these centres that will not tax it, and you structure it so it's not taxed there. That income then, when you move to an onshore state, is what we call clean capital, and that's where you want to be. If you want to get as much clean capital in the bank as you possibly can before you move to an onshore centre. In terms of gains, you want to what we call rebase these gains. So if you've got assets that have pregnant gains, then you want to either crystallize those gains or do some rebasing. So if you've got, say, listed investments, say you've got some shares in Microsoft and Apple that have gone up in value by, say, $500,000, you can sell those now for cash, even reinvest in the same shares if you want to. But what you've done is crystallize those gains when you're resident in a centre where the gain is not taxed, and you've created a pot of clean capital. So they're the first two main techniques: capitalizing income, capitalizing gains. Then you may want to do this technique of separate bank accounts for income and capital. This is important where you're moving to a country, an onshore country, where you're taxed on the remittance basis. And I'll explain what that means in a minute. But for the purposes of this exercise, where before you've moved, what you want to do is have the two bank accounts. One bank account, you put your clean capital which you've just generated and any savings, etc., that you have. And then you have a separate bank account that's set up, and that just receives the income, the interest income normally from the capital account. You can also do this planning with investment accounts as well, where the dividends and etc. that you receive get popped into a separate account, and then you remit into your onshore country of residence from the capital account. Very common technique that was used in the UK over the years when we had the remittance basis system for non-doms, also used in Malta and Cyprus as well, I've noticed. But again, it's suitable for remittance basis residency tax systems. A very key point before you're moving onshore is to review your assets. You'll often find that certain assets, although you're going to be moving to, you may be moving to an onshore state that has tax exemptions, you'll find that certain types of assets are offensive to that jurisdiction. A good example of this in the UK is the personal portfolio bond regime that we have, where you invest effectively in a personalized life insurance bond. It's very, very common to have those assets when you're offshore. If you move, say, to the UK and with such a bond, you're going to be subject with this horrible tax charge each year. So it's things like that that you just need to review before you go to your onshore country, from offshore to your onshore country of residence. And it goes without saying that this is just a general list of principles. You'll obviously have received detailed tax advice from a qualified advisor in the country to which you're moving, which will tailor all of this pre-arrival planning for you. But this is obviously just to give you a taster of the general techniques that are used. It's very common for clients who are based in these tax benign centres to be directors of companies that they own. They need to resign from those companies before they become resident onshore. The reason for that is that those companies will become typically resident with them if they're managed and controlled by them from onshore. So if they can still keep those structures in place, and that's a big if, then you need to make sure that you've got a proper director or directors in place before you become resident onshore. And then the final point, and this leads us on to the next slide, is of course review these structures before you move onshore. It may well be that a standalone company, even if you resign as a director and replace yourself, that may well be caught by the controlled foreign company rules or equivalent in the onshore jurisdiction, and then you're going to be taxed on undistributed profit. So if that's the case, you're going to have to dismantle and you're going to have to restructure before you become resident in the onshore state. So
Lawrence, sorry, just to clarify, just a query around the phrase pregnant gains for the audience. It refers to unrealized, capital appreciation in an asset, right?
Yeah, exactly. So with the example, if you've got, say, some Microsoft and Apple shares, you paid a total of £500,000 for them, and they're currently worth £1 million. You've got a pregnant gain there of £500,000. Yeah. So if you move onshore, you're going to be taxed on that, or potentially it's going to be exempt, but not always, or it's taxed on the remittance basis. Whereas if you just sell the asset while you're offshore, then you've turned it into capital and you've crystallized that pregnant gain. So it's a very common technique that is used. Yeah. So if we just then switch
Still got 3 case studies to do, Lawrence.
Yeah. So just on in terms of these jurisdictions, when clients move onshore, then typically they're going to be moving to a place that they'll move to a place where they're taxed on worldwide income and gains. Certain countries, onshore countries, offer tax exemptions, others don't. So the ones which don't, Canada, US, Australia, Scandinavian countries, the ones that do, typically Spain under the Beckham rule, Italy now, the UK, and other jurisdictions offer tax exemptions, even though the general position there is that you're taxed on worldwide income and worldwide gains. Now, in terms of clients that are moving to these jurisdictions, you need to be very careful when you are moving to these places with tax exemptions that firstly, you qualify for the exemption, and secondly, that your overseas income and gains then actually fall within it, so they're not going to be taxed. With these exemptions, they're typically either based on domicile, so not being domiciled in the place you're moving to. So Malta and Cyprus still use domicile. And as does Ireland, or they look at long-term residents, not being a long-term resident of the place you're moving to. So Spain, Portugal, you can't be resident for 5 years in those places. UK, it's 10 years. UK has obviously switched from a domicile-based test to one that's based on not being a long-term resident. So in terms of the typical structures then that you're going to be using, and these will be paramount in those jurisdictions where there's no exemption at all, and you're purely relying on a compliant structure to continue to provide you with deferral. So family investment companies, which can be set up onshore or offshore. You've got overseas trust planning. This is typically a discretionary trust, which again is tailored to be compliant in the jurisdiction that you're moving to. Foundations are used as a substitute for discretionary trusts for individuals who are not familiar with trusts. And then we have life insurance wrappers, pensions, and the equivalent. And you will probably find that they're the type of structures that are going to provide you with tax deferral in these centres that do not offer you any type of tax relief or exemptions on your worldwide income and gains. Obviously, it goes without saying, final structure will be based on tailored tax advice in the country to which you're moving. Sovereign can generally set up and manage all of that structure on which you receive the advice. Where we can't, then we can always facilitate the extra element of the structure that's required to fit with the advice that's been obtained. And without any further ado, we can now move on to 3 case studies that provide illustrations of what we've been talking about.
Thanks, Lawrence. And these are recent illustrations. We've changed the names of the clients, the users of the arrangements. But we start with the first, Mr. and Mrs. A, fabulous couple. They're currently based in Turkey, been there a long time. They're non-EU nationals. They want to exit Turkey for the political and other reasons. It's time to move. Their kids are living in England, studying in England. But they want to spend time in the US because they enjoy that part of the world. They still want to spend summers in the south of Turkey and a bit of yachting, and they still want to spend time in the UK with their younger ones. But they want to remain non-resident of Turkey, non-resident of the US, because they don't really tend to be spending too much time in these countries, and certainly, in view of the statutory residence test governing non-UK residents, they want to qualify for the amount of days that they can legally spend in the UK past midnight without triggering UK residents. They've got Mr. A has elderly parents. They'd like to spend some time there, but they don't actually want to become resident in those countries. There's the challenge. Solution is that they would like EU rights to move between EU countries. Turkey is just across the water to Greece, obviously, and connecting the EU land. So we've managed to suggest, and they like the idea of being residents of Malta, or applying for the Maltese Global Residency Programme, which is specifically relevant to non-EU nationals. It's friendly. It's an EU country, welcoming of all nationalities, EU and non-EU. They've got a super old-fashioned non-dom regime, so income generated overseas and not remitted is not taxed. And there's a requirement to pay a minimum of 15,000 euros upfront and paid every year, regardless of overseas income, overseas gains, overseas wealth, which is a friendly regime compared to others I could mention. So the requirement of the Maltese regime is to not live in another country for 6 months or more. They'll be living in the US for less than 3 months. They'll be lucky if they get past 90 days in the UK, and they'll have the summers in Turkey, so they qualify there. So non-dom regime of Malta, private healthcare, 15,000 euros in tax, rental of property, and Malta's a good place to stay as well. Fabulous place, very friendly. Tax and succession planning, they have, Mr. and Mrs. A have a combined overseas movable wealth of 5 million. They have younger children, elderly parents. They're not favoring making outrageous gifts to a younger generation. So they're advised, with our guidance as well, to set up an overseas family trust. The beneficiaries are the settlors, the heads of family, Mr. and Mrs. A. Their children and their parents will need a little bit of medical care and help in their elderly years, so they become beneficiaries as well. So the illustration next, Miguel, please, will reveal this. They've appointed Mr. and Mrs. A are contributing an initial bit of capital into the bank account of the trust. I think that bank account is opened in Switzerland. The trustees are sovereign, could be Guernsey, could be Isle of Man, could even be not Malta, because they're going to get the global residency program in Malta. The protector is one sibling from Mrs. A and one sibling from Mr. A, who understand the dynamics of the family. The beneficiaries are the settlor, the two daughters, and that really should say others and parents, because they're quite elderly. The trust fund is cash at bank. The cash is going to hopefully get a return of at least 5%, bit of investment management. Mr. A is only 50, actually. Lucky for him, bit envious of that. And he is still consulting in interior design in related sectors. So he's using his Hong Kong company for undertaking mandates of consultancy. Hong Kong has a territorial tax system, so effectively no tax unless you're sourcing your income and generating business in Hong Kong. And there's a bit of art, jewelry, and car collection, notwithstanding they've lived a long life, a good many years in Turkey, and that's rich in that sort of jewelry, art, and other collectibles. So beneficiaries, settlers, daughters, parents, that trust fund can grow nicely without interference of any taxation. Malta has the famous non-don system. Distributions of benefit will not be paid straight into Malta. And that's extremely tax friendly. That's case study 1, and we had best go to case study 2 to keep time.
Yeah. So Lawrence. Situation here. Thanks, Simon. Situation here is Mr. B has been UK resident for the last 5 years. Was formerly non-dom. Well, still is non-dom, I should say, but was formerly benefited from the special regime, the remittance basis that applied to non-doms, which has obviously been replaced by this new regime, only available, which is not currently which he can't avail himself of. So he is planning for that reason to exit the UK in the next fiscal year, which is the 2026 and 2027 tax year, and he wants to move to Switzerland. And again, he's taken his time to obtain advice on all of this, and he will successfully move to Switzerland in the 26-27 UK tax year. However, the spouse and infant children of Mr. B and this is quite a common scenario, are to remain resident of the UK. He does, though, want to continually visit the family, which it's obviously quite easy to do from Switzerland. So he has quite significant ties with the UK, given that they have the family home still there. His wife and children are going to be there. So it's quite challenging in this instance to become non-UK resident. But the solution, Mr. B secures overseas permanent full-time employment, being employed as a European director of an overseas property development company. Mr. B is advised that this overseas full-time employment should ensure that he's automatically overseas resident under the statutory residence test, and this allows him to return to the UK for 90 midnights, despite the fact that he still has his family in his home in the UK, because he qualifies under that full-time work overseas test. So hopping over to his Swiss position, he's obtained a cantonal ruling that Swiss lump sum, which effectively provides him with a predetermined, his tax position is predetermined by that cantonal ruling. It's very favourable compared to his tax position in the UK, where, as I mentioned earlier, he no longer qualifies for any special relief because he's resided for 5 tax years. So he also decides to set up a structure. In this position, he would have to set up this structure once he becomes resident in Switzerland. Again, this timing issue as to when you set up your structure, he would not want to be doing that while he was resident in the UK, because he would incur all sorts of tax issues, because this is an example, of course, where you're moving from a tax unfriendly place, which the UK is now unfriendly to him, to a tax-friendly place in the form of Switzerland. So what does he do? He seeks to consolidate his directorship income, dividend income, and accumulated wealth and other resources into a discretionary trust. But this discretionary trust is set up as a private trust company, which it basically has a single purpose, which is to act as trustee of the trust. And this will become hopefully a bit clearer in the diagram, and you'll see in a minute. The trust will own various assets, which again we'll see in the illustration in a minute. The main advantages of this structure are twofold, and it's really for future planning. You'll see that, or you'll have noticed that his family, Mr. B's family, are UK tax resident, and it's likely that they're going to remain so, certainly his children, his daughters. So if he made a direct lifetime gift to them, then any return on that gift in form of income and gains would be subject to UK tax. And in the future, it's going to be within the UK IHT net and remain in that net for the beneficiaries, likely would remain in that net. But by settling those assets into trust, it's ensuring that the income and gains can continue to grow tax-free potentially, and remain permanently outside of the UK inheritance tax net. So it's those two main advantages that you're obtaining from using this structure. So if we just move on to the illustration, there you can see it. So just going over the structure, how this works, you've got a private trust company. This would typically be based in, we've got here Hong Kong, Isle of Man, or Cyprus. You would be based on your advice, I think, in Switzerland here as to where he would base this private trust company. But the key point is that that trust company acts as the trustee of the trust. In this instance, we would want the shares in the trust company to be held by a Guernsey Purpose Trust, and that should ensure that the trust company remains in place after the demise of Mr. B, bearing in mind that the family are going to remain resident in the UK. So you can see there that we've got this holding company below, which effectively holds most of the assets. The legal ownership of that is held by the private trust company. We've then got a trust in place, which is obviously a relationship determined by this trust deed that you can see there. And under that deed lists the beneficiaries. Mr. B is a beneficiary together with his spouse and children. Remember, they're UK resident, but this still completely works for tax deferral purposes and for UK IHT purposes. the trust property, as I mentioned earlier, we've got this Zermatt Holdings Limited. Most of the assets are held through that, but we've got some cash which is held directly in the trust. We've got a nominated protector. It's important, I think, with protectors that they're not based onshore. You would not want that protector to be based in the UK. It causes the trust to be effectively it's CR, like becomes reported under CRS when it really shouldn't be in this instance, at least until distributions are made to UK persons. So the basic point is that in this type of case where you've got a mixture between the settlor being resident in Switzerland, other beneficiaries being resident in the UK, you'd want to ensure that the protector is not based in the UK. Ideally, they would be in Switzerland or somewhere else. I've already mentioned, I think, the other points at the bottom. I think with all these structures, aside from tax, it's worth just noting that with any trust, it is providing you with inbuilt succession planning. So you don't have to go through probate or anything like that with assets that are wrapped within these structures. The other thing is that for asset protection purposes, when you're looking at the position of the beneficiaries, clearly holding these assets through a trust structure is going to provide you with them with a greater level of asset protection, or at least it should do, than making a direct gift to them, because when you're settling assets into a discretionary trust, they're not becoming the assets of those beneficiaries. The position is different when you're looking at the actual settlor, but if you're not a settlor and you're just a beneficiary, then as far as they're concerned, the assets should be safer when they're in a trust than if you're making a direct gift to them. So I think that's probably enough on that slide.
Thanks, Lawrence. We'll move on to case study 3. Simon's promise is going to be quick, so we
Very
still have
quick,
5 minutes for Q&A at the end.
Reason I mention this is that these are European Union residents. Mr. and Mrs. C are Spanish residents. They've been there a while. They're exposed to high rates of taxation, and they want to stay and reside in the EU. Mr. C has connections with Greece. I think he actually probably has a holiday home there, and they are mindful to move to Greece and take advantage. It's funny, isn't it? The UK have abolished effectively the domicile regime, whereas Italy and Greece have created one because they find it's really capturing wealth into the country as opposed to going elsewhere. So they've hijacked and borrowed and used our wonderful domicile legislation, which was there for 200 years, and the start of this tax year it's technically vanished. Anyway, there's a non-dom lump sum taxation regime in Greece whereby you pay 100,000 euros. You have to commit to buy property of at least 500,000, still gets you a nice property in Greece, and the rest, and your worldwide income, your non-Greek worldwide income, is not exposed to Greek tax control and taxation. So they're moving from a high tax nation, and 100,000 is modest for their situation because they're still very active entrepreneurs, receiving dividend income, receiving commission income, and deriving income from multiple sources. Key to that, the challenge is not to control and manage overseas companies from Greece. So they shouldn't be boards of directors and controlling the board from Greece. So what we've done here is create an overseas family investment company. They prefer companies than trusts. The overseas family investment company is going to carry on invoicing for commission, mandates, trades, and consultancy. The family investment company is controlled by offshore directors provided by Sovereign, and we do provide the fiduciary management services, corporate governance, full transparency, proper management control exercised offshore, not from Greece. The FIC is also going to be geared to acquire the property companies that the Mr. and Mrs. C have contributed wealth in the past. So they're going to move the property companies into the FIC so that everything is consolidated in the FIC. And the family investment company, a glorified company because it's a straightforward company, overseas, not in Greece, not in England, not in the US, not in Spain. It's registered with 2 share classes. the founders are going to own share class A and B to start with, and they're going to gift share class B to their children, having rights of growth, rights of dividends, whereas Mr. and Mrs. C are going to retain share class A, which will be rights to vote, rights to dividends, and rights to any loan capital. And Lawrence is just going to canter you through the illustration, Miguel. Next slide, and really last slide before Nick comes back and makes some closure remarks and questions. That's what it looks like. And that works rather well. We undertake UK and overseas family investment companies, depending on the situation of the client. Lawrence, quick minute on this, please.
Yeah, I mean, the illustration, I think, you can see it all from there. It's divided between two classes of shares: the A shares that are held by the founders, B shares held by the children, and the B shares in this instance are the growth shares. The A shares effectively lock in the rights to income and capital when the company is set up, and then the growth rights are held with the children. I think the only final point I'd make on family investment companies, they are used for succession planning, but do note that the founders here, Mr. and Mrs. C, they actually still hold the shares. So it's not providing you, may provide tax planning benefits and asset protection potentially, but it won't provide succession planning if you're holding the shares, because you're still going to, when you die, those shares are going to still exist. So you will need to either ensure that you've got a will that will transfer those shares validly when you die, or indeed look at a trust to hold some of those shares in. So family investment companies and trusts are often used in conjunction.
In combination, that's right.
Yeah.
Okay, Nick.
Good stuff. Thanks everybody. Sorry, Q&A. We now have a very short period. I'm sure the speakers could stay on for 5 or 10 more minutes at the end of the session if there are any questions and you want to have them answered. There is one question in the chat which was relating to the pregnant gain, Lawrence. So Paula asks, if the shares have a pregnant gain, but in parallel you have loans and or other shares that are held at a loss, can you offset these all in?
Yeah, I think that would obviously, I was looking earlier at the obvious area where you've got listed investments where it's dead easy to calculate what the gain is. But yes, if you've got a private company and you've made loans to that company, then you would be looking at calculating what you put into the company as your base cost, which is typically what you put in as share capital, and then what the market value of the assets of the company is before you go onshore. Now, if there's a loan outstanding, then you would net that off against the value of the assets to work out what the market value of the shares in that company would be. But I didn't get onto loans today. They are a tricky area, and that's definitely something you'd want to be looking at in your pre-arrival planning. General advice with that would be to have those loans repaid before you become resident onshore. But again, it's all very much on a case by case.
I think here the point is that the pre-arrival planning is just so important. You have to get it right, because from the moment you move back, there's nothing you can do about it. So that's where
if you're moving from offshore to onshore, in that instance, if it's the other way around, then really you don't want to be doing anything. Yeah, in most cases, but there's always exceptions to the general rule. But yeah.
So please, we are running out of time. We will answer any questions that come through after the allotted time by email. I forgot to mention at the top that the session has been recorded. So a few of you have messaged me to say you've had to log off. So the full transcript will be sent to you. And please do get in touch if you would like to further the conversation with any of the speakers on today's webinar. Just one final point, the next webinar, this is a series of 3 webinars. The next webinar will be taking place on the 24th of March. We will be sending out invites to all of you who have attended today so that you can attend that one too. We look forward to seeing you there. That will be on cross-border tax planning. So we're sort of talking about some of the themes today, but just furthering on and moving around that pie chart that we showed at the beginning. So I think without further ado, we've reached the top of the hour. We'll let you get back to your days. Thank you very much for attending the session. Thank you to our speakers today. Thanks to Miguel and Jesse for organising today's webinar. And I think that's a wrap from all of us. We look forward to hearing from you. Thank you.
Thank you.
Thanks, everyone. Thanks.
Bye-bye.
Bye.